Good evening, ladies and gentlemen. A very warm welcome to FSM1.com's flagship event, What and Where to Invest 2021. This year, FSM1.com intends to help you put together your investment survival kit to ensure that you survive and thrive in your investing in 2021 and beyond. We have a lineup of online presentations today, as well as on the 14th, 19th, 21st, and 26th of January in the evenings from 7 p.m. to 9 p.m. Over this series of presentations, we'll cover various topics to put together for you a suite of survival kit items and the respective tools that will help you as an investor as you navigate new market conditions in the coming year. Today is also the start of the opportunity for you to earn chances towards our lucky draw. Be sure to join us each event day till the 21st of January to earn chances to help you win in the lucky draw. Accumulate chances throughout the event for the draw happening on the 21st of January, where the winner stands to win up to $1,000 worth of FSM1 AutoSweep account credits. To be eligible, head to the event live via the link in the confirmation email you received when you registered for the event. Remember to use the same name or nickname and email address in order to accumulate the chances. You can get one chance per day by logging on each event day till the 21st of January 2021. You can also get one chance per day by participating in the daily quiz sessions. You can also get your chance by completing and submitting the survey on the 21st of January 2021. You can also get your chance by visiting our partners' pages, Nikko AM, Schroders, UOB AM, and Allianz Global Investors. Lastly, you can also get your one chance by sharing this event on your social media through the social media buttons on the footer. Remember to access Event Live using the same name or nickname and email address each day so that you can accumulate as many chances as possible. Each day, you can also take part in a daily quiz where we will be giving away $100 worth of FSM1 multi-currency cash account credits to 3 lucky winners during the sessions until the 21st of January. If you're wondering what this 3D First Aid Kit here represents, it is a key item in one's survival kit and also outlines the theme for today's presentations. If your portfolio has been wounded by the bad experiences in the markets, find out which asset classes and investment themes can provide that healing touch. As we gear up for the start of the sessions today, you'll note that we have opened up a poll for today. So do interact with us and the various people watching in sharing your experience and opinions in the polls. To participate in the poll, firstly, click on Event Activities on the menu below this video. Under the agenda, look for Poll Schedule, then click on the Join Poll button. The poll window will be displayed on your right. You ready? Let's start the poll. Question number 1. How confident are you for your investment portfolio to survive and thrive by the end of 2021? Do you believe that you will thrive or you'll survive? Oh, wow. Okay, so 41% of us think that we will survive and 24% of us are still uncertain. Hopefully today's session will help you in figuring out which way you will go. Question number 2, do you intend to invest in any fixed income products in 2021? Option 1, corporate bonds. Option 2, bond funds. Option 3, bond ETFs. Option 4, a mixture of bonds, bond funds, and bond ETFs. Or you're not interested in any fixed income products. Do share your experience, and we would like to hear. A majority of you are not interested in fixed income products. Question number 3. Which sector are you most bullish on in 2021? Is it technology, financials, REITs and real estate related, defensive stocks, or healthcare? Which are you most optimistic about? Wow, 55% of us are most optimistic about technology. Thank you for sharing your experiences with us. And with that, let's kick off today's session by helping me welcome to the stage Ong Zi Yang, Senior Analyst, Macro Research at IFAS Singapore, to present Where Should Investors Invest in a Post-Pandemic World?
Hi, ladies and gentlemen. Welcome to the FSM1 What and Where to Invest event for 2021. I'm Ziyang, a senior macro analyst with IFAS, and today I'll share with you my thoughts on where should investors invest in this post-pandemic world. 2020 has been a pretty challenging year for the global economy as the world struggles to contain the COVID pandemic. However, things are starting to look a lot better now in 2021, with the COVID vaccine gradually rolling out across the world. Which leads us back to the question is how should investors invest in as the global economy recovers? To begin, I would like to set some context into the macro backdrop we are in right now. Understanding where we are in the global economic cycle will be very important for us to invest properly ahead. We believe we have passed the trough of the economic cycle back in the first and second quarter of last year and is quickly moving into the early phase of a global economic expansion. And our optimistic outlook for 2021 was backed by four main factors. First is a vaccine-led global recovery. With the various COVID vaccines starting to roll out this year, we believe that there is a good chance that the global COVID outbreaks can be contained this year, enabling borders to reopen and governments to loosen travel restrictions again. Second is a supportive monetary policy and fiscal spending that we think governments and central banks will likely maintain this year to help encourage economic recovery in their respective economy. As a result of that, corporates' earnings are likely to rebound double-digit this year, partly due to the lag effect of the record stimulus that was implemented last year, as well as the low base effect because of the earnings decline last year as well. I think last but not least, we also expect that the risk backdrop to be less challenging than last year. Aside from the emergence of the new COVID variant, the US-China relation are likely to be less erratic under Biden than under the Trump administration, which is one less thing that investors need to be concerned about. And overall, the outlook for 2021 is building up to be more optimistic compared to last year. And we are starting to see some of those cyclical recovery taking place as we speak. While the economic activity plunged in the first half of 2020, they have since recovered across the third and fourth quarter of last year, across the majority of the economies. And moving ahead, we expect the recovery momentum to continue. Another sign of the classic cyclical recovery is that of the global trade and export activity. As you can see from both of the charts, trade have rebounded sharply by the end of 2020, in somewhat similar fashion to that of the end of the previous recession. Export growth of major exporters are also turning positive, with China and South Korea, notably economies that come from the Asia region, are clearly leading the growth compared to global peers. As a result, we can expect that global economic growth to turn constructive by 2021. I think it's important to note that Asia and China has managed to avoid a contraction in 2020 and is set to lead in growth this year, thanks to their better management of the COVID situation within their domestic population. At the same time, the COVID vaccine, the rollout of the COVID vaccine across the world could also potentially fast-track the pace of global growth recovery this year as well. But with valuations of global equities now trading at the top of their historical range, it's difficult to find any cheap market out there right now. Therefore, the key to investing in 2021 will be to be selective and to cherry-pick markets with strong economic fundamentals. Therefore, on the geographical basis, we naturally gravitate towards the Asia and emerging market ones as our favorite market this year, especially as their economic fundamentals have improved significantly as compared to the rest of the world, which are still struggling with the new wave of the COVID outbreak. Interestingly, because 2021 outlook ahead is positive and favorable for equities, there is no market which we think is unattractive this year. Back to the main question of the day, where should investors invest in this post-pandemic world? We have been asking ourselves this question, and if we were to pick up top 5 ideas for 2021 global cyclical recovery, what would they be? So over the next few slides, I'm going to share with you these 5 ideas. First up, I think no surprises here, we have the emerging markets. We think emerging market equities are the most well-positioned for a global cyclical recovery, given their sensitivity to economic condition. The early phase of the cyclical expansion is traditionally very helpful for earnings growth in the EM equities. But not only that, the weakness in the dollar, the US dollars, the commodity upcycle ahead are also key drivers to look out for EM equities in 2021. Historically, immediately after a recession, the subsequent GDP rebound for emerging markets are typically stronger than the historical average level of 5.5%. And this has taken place over the last few recessions. Though we think that EM as a whole is going to face a slight contraction, about 1% for 2020, we think that growth will rebound above 6% this year and the next as well. As mentioned just now, the early phase of cyclical expansion is traditionally very helpful for the earnings growth in EM equities. As you can see from the last 2 recessions in early 2000s, as well as the 2008 great financial crisis, earnings growth tend to move in cycles for the EM as well. Therefore, we believe that earnings are likely to rebound strongly this year and next year if history serves as any reference. And at the same time, US dollar is heading towards a multi-year down cycle. There's quite a few reasons for it, and I think one of the key reasons is, of course, the greater asset purchases that the Fed has been embarking on from across 2020 and 2021. It's also facing a structural twin deficit of current account and fiscal deficit that is not helpful for. And of course, at the same time, its economic growth is going to underperform versus the rest of the world, which will weigh down on the strength of its currency. And dollar weakness is traditionally a very big tailwind for EM equities. As you can see from the high correlation in the chart displayed on the screen, between the dollar trade-weighted index as well as the EM index, primarily because many EM issue bonds in US dollar, and the weakening dollar makes it easy for these EM to finance their interest payment in local currencies. Next, I think the commodity upcycle, typical of a cyclical expansion in the global economy, is also another major tailwind for the EM equities. Commodity prices tend to pick up as global economy expands, and the rising prices benefit commodity exporting EMs, especially within the Latin American region, where earnings growth tend to correlate strongly with the movement of the commodity prices, as you can see from the chart on the right. All in all, I think as a result, I think we can expect that earnings for EM to come in at a double-digit growth for 2021 as well as 2022. While EM equities prices have rose significantly over the last few months, we think that there's still ample room for EM equities ahead, with our potential upside close to 20% by the end of next year. Within the emerging market space, our second best idea is actually, our favorite segment of the year actually, is the Asia ex-Japan equities. With China and Asia starting the year with firmer economic footing, in part due to the better COVID management, we think that Asia equity stands a good chance to lead performance in global equity market again. The rebound in electronic exports due to the rising demand for remote working, as well as studying due to the COVID lockdown situation, as well as the incoming 5G upgrade cycle, is a boon for Asia economies like China, South Korea, Taiwan, which made up as important nodes within the global electronic value chain. And we have seen strong rebounds in export growth in the chart that I have shown you before. And this is partially, because of the trend of the electronic exports. At the same time, many of the major headwinds that were facing the region last year have since subsided. COVID uncertainty has faded on the strong track record of their COVID management within the Asia region. The US-China tension will also likely to simmer down under a Biden administration. And the stretch valuation of 2020 is starting to look more reasonable ahead with the robust earnings growth amidst a better economic fundamental. As part of the dual circulation strategy implemented this year, we believe the near-term focus for China will be to spur its internal consumption by stimulating consumption nationwide via a combination of monetary and fiscal stimulus. And peripheral economies like Hong Kong, Taiwan, South Korea, Southeast Asia are likely to benefit given the strong economic ties and trade partnership with China. The recent RCEP trade agreement is one key boon for economic cooperation within the region for the next few years ahead. As you can see from the chart, whenever money supply in China starts expanding, we can expect a strong earnings recovery for Asia to follow. And for equities, corporate earnings growth within the region is on track for a rapid double-digit rebound in the next 2 years, at 27% for 2021 and 18% year-on-year for next year. We can expect earnings to recover to pre-COVID level in third or fourth quarter this year, easily 1 to 2 quarters ahead of global peers. With the volley of tailwinds and attractive upside, Asia ex-Japan equities offer one of the most favorable risk-to-reward profile. Within EM, these are my top 5 markets. As you can see, many of them are within the Asia region. And on aggregate, they have an upside potential of over 20% within the next 2 years. Our positive outlook on Asia and emerging market region extend beyond equities. With yields on the safer end set to remain painfully low, many bond investors, including ourselves, will be out on an aggressive search for returns in the riskier, high-yielding segment in 2021, partly driven by the rising risk appetite and the improving economic and credit fundamentals of corporate and sovereign bonds around the world. Across the board, bond yield across all segments are actually trading below their average level already. And we think that there's a good chance for yields to persist at the current level for the year ahead, given the accommodative monetary policy stance by global central banks. This means that Asia high yields will look more attractive ahead as investors hunt for yields. From a valuation standpoint, bond yields of Asia corporate issuers stands out. Option-adjusted credit spreads on Asian high-yield bonds are significantly more attractive than the European and US counterparts, where spreads are already below their respective means. And with the broader improvement in risk appetite and demand for good quality assets likely to be the focus of bond investors ahead, we think Asian high-yield bonds are likely to continue to perform well. It also helps that Asian high-yield has ample room for spread compression towards pre-COVID level, meaning that investors who are trading these bonds short-term will also be able to generate capital gains on their bond investments if they choose to cash out early. The fourth idea would be semiconductor industry. It's one of the immediate beneficiary of the COVID pandemic as businesses speed up the adoption of technology and families to adopt remote working and schooling setup, driving demand for semiconductors in computers and smartphones. Not only has the industry not been badly affected by the pandemic as previously expected, sales growth remains robust in the coming years as the world became increasingly digitalized. Semiconductor demand is going to be supported by applications such as 5G and cloud computing. As you can see on the chart on the left, semiconductor sales typically are very cyclical driven. Such upcycle typically lasts about 6 to 8 quarters. Right now, we are just at the front end of the upcycle, which means that the growth momentum ahead will likely continue for the next 4 to 6 quarters. And as the backbone of all electronic products and applications, semiconductors will be one of the most important sectors supporting the digital economy. With the world becoming increasingly digitalized, we believe that the outlook for the semiconductors look particularly rosy for the next 2 years ahead. Last but not least, the global financial sector. In light of a potential vaccine rollout, we remain positive on the global financial sector as a long-awaited rotation into value begins. And it's driven by 4 main factors. Return of return of dividends and share buybacks, the cyclical driven EPS growth via expansion in net interest margin, the fall in net interest loss provision because of the COVID situation is no longer going to be a headwind for the global financial sector. And last but not least, the recovery in interest premium is going to be a very big boon for the financial sector as a whole. And earnings this year is expected to register a decline, last year actually, a decline of 20% before jumping double-digit 20% and 15% this year and next year respectively. We expect investor sentiment to improve given the successful vaccine rollout and possible resumption of the dividends and share buybacks across banks. And financial sector stands as one of the key sectors to benefit from a global cyclical expansion. To summarize the whole presentation again, on the macro side, we maintain a constructive growth outlook for the world in 2021, driven by a vaccine-led cyclical recovery. This means that equity, EM, and Asia equities are likely to outperform Western developed world equities. Similarly, for fixed income, the rising risk appetite spells positive for Asia and EM high yields as credit and economic fundamentals improve and bond investors to go on an aggressive hunt for higher yields. Last but not least, on the sectorial level, we think that semiconductors, global financials, and global healthcare are top picks which we feel more convinced by with the global cyclical recovery well underway in 2021. Finally, I'm going to end my presentation with this one last slide. If 2020 has taught us anything, it's that investing is a long-term game, which will pay off with discipline and patience. Based on the chart of an aggregate of all Asia ex-Japan equity funds traded on our platforms, investors who have started investing at the start of the last decade would have seen their money doubled across the last 10 years. Looking ahead, with China possibly overtaking the US as the largest economy by 2026, which will help lift the growth of the entire Asia region, we believe we could be seeing another of such stellar performance for the next 10 years. For investors who have been sitting on their hands while global equity markets recovered strongly after March sell-off last year, you're still not too late to invest right now. And the top 5 ideas that I've shared just now could very well be the first place for you to start. And that will be the end of my segment. Thank you.
Thank you, Ziyang. The current pandemic showed how gravely unprepared the world is at dealing with extreme situations. It has also taught investors many valuable lessons and was also a stress test for many of our investment portfolios. Some performed admirably, while others less so. In the next presentation by Ron Ng, investment advisor at FSM1.com Singapore, we will explore the themes of resilience and diversification to defend our portfolios against another pandemic.
Hello everyone, thanks again for joining us. My name is Ron from the FSM1 Investment Advisory Team. And this session will be less of a market update or outlook, but rather we'll be sharing with you some evergreen investment strategies adopted by successful investors. So other than strategies, we'll be presenting on our regular savings plan and how it can be a useful tool for your investment journey with us. We'll also be addressing some investment myths. And of course, we'll round up the session with some qualities of the successful investors we observed at FSM1. Now, a few disclaimers before we start this session. So, survival does not equate to normal portfolio growth even when there's a crisis, because even our bank accounts have their interest rates slashed. So there are no guarantees when it comes to investments, because every market crisis is different in nature. And of course, logic and patience is still the best virtues for investors out there. So the key strategies we'll be going through today are risk and reward, understanding its trade-off, how investment horizon affects our portfolio return, importance of asset and geographical allocation, how to construct a portfolio, having different types of portfolios to cater to different investment objectives, and using regular savings plan for dollar cost averaging. So when it comes to investing, there's always a trade-off between risk and reward. Investments that generate higher returns usually entails higher risk, be it a potential loss of principal or to see your portfolio value plunge drastically during weaker market conditions, such as the global financial crisis. The higher returns are given to investors to compensate them for the higher risk that they are taking on. Therefore, we must bear in mind that every investor's best investment differs from each other. We know a lot of investors out there have a desired return before they start investing, which is normal. But before you decide on your desired return, maybe you can ask yourself some of these questions. How much can I invest? How much can I bear to lose from my investments? How long can I stay invested? When do I need this money? And why do I need this money? Having clear answers to these questions will definitely make us more logical and patient towards investing. So we can never emphasize this point enough that investment horizon is the most important factor when it comes to determining your portfolio's asset allocation. If we look at historically how assets have performed over time from 1950 to 2018 in the illustration at the bottom, what we can observe from the chart from this chart is that the shorter our investment horizon, the more likely we are to lose money while investing. Our investment time frame will play a role in deciding how much to allocate to equities or bonds, which in turn affects whether a conservative or aggressive approach is more suitable. If we do not need the money and can keep it invested, perhaps adopting a more aggressive stance would be more suitable, since we have time on our side to ride out volatilities in the market. Portfolio diversification is also key to riding out these volatilities. Diversification includes two components: diversifying across asset classes, which is your equities and bonds, and also across regions, be it global, Asia, emerging markets, or sector country specific. We'll explain the differences in the next two slides. So traditionally, stocks as an asset class have generated higher returns across long periods. Even though bond funds are unable to achieve these returns like equities over the long term, having bonds help to reduce your portfolio volatility. Historically, this chart shows how markets performed over the past 10 years. The table in the slide might look a bit messy, but maybe I can direct your attention to the light purple color-coded Asia Pacific x Japan. So in 2017, it was the top performing asset class. 2018 saw it slip to the bottom performer, followed by a great rebound into second best in 2019. Now, if your portfolio consists only of Asia Pacific x Japan equities, that period would have been very uncomfortable. How much to devote to stocks and bonds or other asset classes is determined by your risk tolerance, investment time frame, and investment objective. Diversified portfolios, color-coded in maroon, which consists of both bonds and equities, has shown to be more resilient or has lower volatility in weaker economic conditions and achieve a better risk-adjusted return in the long run. That is why we advocate to have a good mix of equity and bonds based on your risk appetite. So here is an example of how we advocate based on each individual's risk profile. So for those who are just starting out to invest, you're just starting out your investment journey, you can probably consider a neutral allocation, which is in the middle. Again, in terms of yearly performance, there's really no consistency as to which region always comes out on top. We strongly believe in the merits of a globally diversified portfolio, as a broader diversification strategy helps to mitigate abrupt market swings. This is because different regions experience varying economic growth rates, and a globally diversified portfolio would allow us to benefit from such global economic growth without worrying much over concentrating our investments within a single region. So, with all the diversification and risk-reward trade-off, how exactly do we construct an investment portfolio? For starters, you can first picture your investment portfolio as a soccer team. You are the team manager, of course. The money market or short duration bond fund in your portfolio would be the goalkeeper. Equity funds can be described as midfielders, and bond funds can be related to defenders in your team. The strikers would be our aggressive single country or single sector funds. So no managers or no football managers would field 11 strikers. Likewise, you are unlikely to win a game fielding 11 defenders. Therefore, our preferred way of investing would be to cover the entire field through global diversification. Similar to a soccer match, in-game tactics can be tweaked by adjusting the weightage of assets in your portfolio. Underperforming players can be substituted when you review and rebalance your portfolio. Now, I know for soccer fans out there, you know that 4-4-2 is pretty much outdated, and most managers would prefer 4-3-3 or 4-2-3-1, while our point still stands. Each position has its own purpose, and like how each fund should be carefully selected in your portfolio. So, in our modern society, we have to juggle multiple roles. So this results in us having different financial objectives at the same time. So we need to plan for our children's education. If you're a parent, you need to also plan for your own retirement. And also, you still need to make sure you have enough spare funds in your bank account in case of any emergencies. So to help us better manage our finances, it is imperative for us to group our objectives according to the time frame we have to achieve them. What you see here is what we refer to as a bucket strategy, where we organize our objectives into different buckets. The first bucket, which is to build up our readily available emergency funds, can be invested into money market funds or short duration bond funds. The second bucket, for goals we are looking to fulfill in the next 1 to 3 years, can be invested into short duration bond funds as well. The third bucket, which is linked to investment objectives within the next 5 to 7 years, can be invested into balanced funds. That means the funds consist of both equities and bonds. Fourth bucket, designated for long-term growth of more than 10 years, can be invested into equity funds. So a final strategy is something that FSM1 constantly advocates, which is investing through a regular savings plan. Even with a vaccine for this pandemic, cases are still on the rise. So we can expect choppy, volatile market conditions for the year ahead. As such, we would suggest investors not to empty your ammunition too quickly. It will be better to deploy your money in tranches because markets can turn quickly. This also helps to remove emotional stress and achieve realistic returns over a long term. And for the uninitiated, you might be asking, what is a regular savings plan, or RSP for short? It kind of sounds like an insurance plan, doesn't it? But maybe I can just take the next few minutes to go through the products available for RSP on FSM1 and its key benefits. So namely, the products available for RSP on FSM1 are unit trusts, exchange traded funds, ETFs for short, and MAPS, which is our managed portfolio service. So first up, let's look at unit trusts, what it actually is. It is an unlisted, actively managed investment portfolio that can consist of stocks, bonds, or both at the same time. The investment monthly contribution minimum amount starts at $100 for most unit trusts. And what we like about unit trusts is that it allows us to tap on the fund manager's expertise in certain areas. For example, some managers have a track record of picking undervalued stocks in the Asian region or the tech sector. There's also greater flexibility in selecting what goes into the fund, which could generate potentially higher returns than related indices. So ETFs are similar to unit trusts, as both investment portfolios can consist of stocks or bonds. The main difference is that ETFs are listed on exchanges such as your SGX, Hong Kong Exchange, or New York Stock Exchange. It is also passively managed, which means there are no fund managers to pick what goes into the portfolio, or rather, it just tracks and replicates the performance of an index, like the Straits Times Index or the S&P 500. Minimum monthly subscription starts from $50 a month. It generally costs lesser to invest in ETFs than unit trusts, as investors don't have to pay fund managers and his team of analysts to find and pick securities to put in the portfolio. Also, because ETFs track a single index, the risk associated generally would not significantly exceed that of the underlying index, as there is greater certainty over the securities that goes into the ETF. Finally, MAPS is our in-house managed portfolio solution, which we invest on your behalf. Generally, MAPS is suitable for new investors who are unsure of what to invest in, or individuals who are too busy to monitor their investments. Well, of course, there are no restrictions on who can invest in MAPS as long as you have an FSM1 account. Minimum investment amount is slightly higher at $500 a month. The good thing about MAPS is that it lets you leverage on FSM1's analysis and fund selection, which includes both unit trusts and ETFs. And portfolio upkeep is done by our in-house portfolio managers. So at this point, you might be asking, what's so good about an RSP? So basically, first, RSP is a product that forces you to save or invest in a disciplined manner and not letting emotion get in the way of our thinking. There is also no need to invest an initial capital. We can also make use of dollar cost averaging mechanism to ride out market cycles. And we have no lock-in period, which allows you to withdraw your savings anytime in case of emergencies. You are also able to adjust your monthly contribution amount. So if you had a pay raise, you can increase it. And if you need to allocate funds to other areas, such as your mortgage loans, you can decrease it. You just need to take note of each product's minimum monthly investment amount. Now, before we end off this session, maybe we can take a couple of minutes to address some investment myths. Now, this graph shows how global equity and global bonds performed in 2020. Looking at it, you don't have to be an investment guru to see that the best time to invest was in March, April last year. But as the saying goes, hindsight is always perfect. How many of us dared to buy in March 2020? Because we all know there's nothing stopping the low from going lower. So for those familiar with FSM1, you will know that we are strong advocates of long-term value investing because we can never know where the bottom is. This is why it is so important to leave your emotion out and invest diligently. Next myth we can address is portfolio rebalancing. So basically, if you invest 50% into bonds and 50% into equity, for example, under normal market conditions, normal market growth, your equity portion will outgrow the initial allocation and tip the portfolio out of balance. So portfolio rebalancing refers to the action of adjusting the proportion of various investment instruments back in line with the targeted allocation. Sounds like a good idea, right? But how often should we do it? Well, in a series of rebalancing experiments conducted by FSM1, rebalancing too often can incur unnecessary costs like brokerage fees or sales charges, even though it is free to switch around unit trusts on FSM1. So, all in all, the key to rebalancing is to do it on an annual basis. Finally, let's end this session with some qualities FSM1 has observed over the years from successful investors. Well, if you just Google qualities of a successful investor, you'll be able to find plenty of practical results. But many of these results are easier said than done. So maybe we just focus on a few that is within our control, like having the holding power to weather the storm. Now, for normal investors like us, holding power needs to be built up over time. And you might have heard this before, maybe some experienced investors saying that they are fine to lose this amount of money from their investment as it is their spare funds. Okay, this might be overwhelming or intimidating to many, but if you think about it, it is just an oversimplified way of explaining the bucket strategy we shared earlier. Because, right, the first 3 buckets of their portfolio is full. That's why they can afford to take on riskier investments when they have no immediate need, because they have no immediate need of this sum of money. And lastly, being logical instead of emotional and having the courage to buy more during market dips, these two walks hand in hand. And maybe I'll just leave you with this thought before I go. Think about the half-price sushi after 8 p.m. at your local supermarket. Unless you're super paranoid, most of us have no qualms buying this sushi at half the price after 8 p.m. Because when we buy, we know the true value of the sushi. So if your investment portfolio is made with quality value, there's no need to panic when there's a pandemic. Thank you, everyone.
Thank you, Ron. Before we move on to the next presentation, do check out the unit trust promotion that FSM1.com is currently running. Receive $10 bonus units for every $10,000 invested in any of the 21 unit trusts from our top 5 markets and 4 mega themes. Which are these 21 funds? Head over to FSM1.com to find out. This promotion lasts until the 31st of January 2021. You can also, for a 6-month period from 8th of February 2021 to 31st of July 2021, enjoy a 0% processing fee when you transact via a regular savings plan. There's no better time to get started with ETF RSP. Open an FSM1.com account in just 5 minutes today via MyInfo. From the 9th of January to the 26th of January, open a new FSM1 account to receive 3,000 rewards points. To enjoy this promotion, you must click on the Promotions tab on the black menu bar and complete the form via the Account Opening Promotion form. Then click on the Submit and Proceed to Account Opening button to get to the FSM1 account opening page. If you know of somebody who does not have an FSM1.com account, now is the best time to get them to start one. Refer a friend to open an FSM1 account from today till the 26th of January, and you will stand to receive 3,000 rewards points for each friend, up to a maximum of 15,000 reward points. Do note that if your FSM1 account was opened directly on our main website without submitting the form below, you will not be eligible for this promotion. Also, if you have any questions regarding the presentations today, leave them in the Q&A section by clicking on the Ask Question button, and we'll have our speakers take these questions later on today. Up next, we have a panel discussion where Dexter Tan, Senior Analyst, Fixed Income Research, IFAS Singapore, Sean Tiao, Senior Analyst, Unit Trust Research, IFAS Singapore, Joshua Chim, Assistant Manager, Cash Management and Treasury, IFAS Singapore. And moderating this session will be Catherine Chua, Assistant Manager, Investment Advisory, FSM1.com, Singapore. We will discuss bonds versus bond funds versus bond ETFs and their outlook for the fixed income asset class and what should income seekers pay attention to.
Thank you, Geraldine, for the introduction. Welcome to the panel discussion, and today we'll be discussing about the different asset classes of the fixed income assets and the products available, and some of the key concerns that new investors should be aware of. So to start the ball rolling, maybe I'll just post the very first question for this discussion. It will be, what is a bond, to be exact?
All right, since I'm seated next to you, so I shall answer first. So bonds are debt instruments that actually issued by company to raise funds. Typically, bonds they have a fixed maturity dates. So upon fixed maturity dates, the bond issuer will actually pay back the par value to the bondholders. So on top of that, the bonds issuer also pay regular coupons at intervals to the bondholder. Last but not least, bondholders are ranked above the equities holder in the event of liquidations. This means that if the company is closing down or winding down, the company has to pay the bondholder first before they are being paid to the equities holder. So these are actually a strong key benefits of investing in bonds over equities.
I see. So actually, having a bond portfolio could actually build like a steady stream of income, right? Because like, you know, bonds, they give interest in the forms of like coupons, and all these are like guaranteed. Am I right to say that?
Yes, so most of the bonds actually they pay on a semi-annual basis. So if you're investing in bonds, you probably have to receive coupons on twice a year. So if you're able to identify bonds that actually pay dividends, coupons, on different months, like for example, bonds A you pay on January and July, another bond B paying on February and August, you actually create a bond ladder by yourself so that actually receive coupons on a monthly basis throughout the whole year. Or you can actually invest in bond funds that actually pay out monthly coupons for you.
I see. So with the bond fund, right, you do get like dividends and so on and so forth. So same with like bond ETFs. So there's been like a talk of town, like, you know, which should we actually invest? Like, you know, direct wholesale corporate bonds, or should we like buy into like bond funds for diversification, or ETF because it is cheap? So is there any comments on any of these?
Maybe I'll just chime in a little bit. I think what to invest really depends on the investor, but I would say for most investors, a bond fund would be quite useful because I think the barrier of entry for when investing in bond funds is much lower when you compare it to investing in individual corporate bonds between the two, bond funds are much easier. Why? Because number one, you have very low minimum buy-in requirement, which is on FSM1. I think most bond funds require just $1,000. And also, I think bond funds also allow you to have a regular savings plan, which I think Ron has shared quite a fair bit about the benefits of regular savings plan and how it can help to build your wealth. But for ETFs, I would say that the RSP options are quite low. So from this perspective, I actually do like bond unit trust a lot, for that reason.
Yeah, maybe I just add on to that point. So I'm actually looking at bonds. So I think maybe for bonds, I think personally I'm biased, but so I would prefer bonds over bond ETFs or bond unit trust. But I think every investor should have some bonds in their portfolio, because I think bonds, they actually provide, in some instances, uncorrelated market returns. So, I mean, there are some instances whereby we have seen whereby bonds are holding up pretty well, but the entire market can be falling. So I think last year when we had this example whereby the entire market, so that was at the beginning of March, and then there was this bond by Aspil Corporation, I think it's 5.3%, that's maturing in 1st of April. So this bond was actually maturing in April, and then in March when we had the onset of the coronavirus, and then the risk appetite of the market was actually falling. So the entire market was falling, but this bond was holding up pretty well. So I think just by adding, just imagine if you had this bond within your portfolio, it will help to like offset some of the negative returns of the other asset classes. So this is just an example of how beneficial you can an investor may have just by adding bonds to a portfolio, because sometimes a bond has uncorrelated returns to the entire market. Yeah. So it's because maybe it's approaching maturity, or maybe if it's a perpetual security, it's approaching its call date, and as a result, the bond price the prices may be supported. Yep.
Okay, so I do guess like there's each to its own, but for wholesale corporate bonds, we do understand that the minimum lot size is usually $250,000 for just one lot, and sometimes we do have this misconception that bonds are actually fairly illiquid, especially when there is very thin volume traded. So does individual bonds or like bond funds or bond ETF poses like such a risk?
Yeah, maybe I'll just start off with answering that. I think when investing in bond funds, you don't actually face all these liquidity risks that I think you have mentioned, because bonds, as you know, individual bonds, as you know, they don't actually trade frequently as what you see in stock markets, right? So on some days you might not even have daily pricings for certain type of bonds. But I think what bond UTs can offer is, at the end of the day, you will always get an NAV pricing. So let's say you invested $10,000 in this bond fund five years ago, and you would like to withdraw some of the money. You can actually have a pretty good idea of how much you will receive the next transactional day, right? But perhaps for bonds that haven't been traded for weeks or months, then you might not have a very good idea. That's from my perspective. Yeah.
Okay, I see. So actually, like I mean, talking about liquidity-wise, so we do understand like bond funds and bond ETF, and in fact, wholesale corporate bonds, there's actually do have day-to-day liquidity, and you can actually do sell them anytime. So for clients who have, don't have very long-term plans for the need, just want somewhere, to get a little bit better yield than whatever the banks are providing, like, is there such instruments that we can consider on our platform?
Okay, so I will take this. Yes, now we are living in a low interest rate environment, so there can be advantage and disadvantage. Advantage is like your housing loans can actually reprice it at low interest rates. But on the other hand, if you are doing saving into your bank accounts, the interest rates have been quite low. So interest rates have been low since the beginning of 2020, and it's probably going to continue until at least until 2023, as what mentioned by the Federal Reserve. So a good example is like the Singapore Savings Bonds that was issued on January 19 was actually giving up 2% if you put in for 1 year. But fast forward to 2 years from there to now, January 2021, the latest issue is only like 0.3% if you put to 1 year. So what's good about that is that we have on FSM, we actually have this product by the name of Auto Sweep. So this product actually comprises of a cash fund from Fullerton and also short duration bond funds from Lion Global. So they are actually a relatively safe asset class as compared to your equities or your high yield bonds. Yeah. So and one good thing about this is actually can use it to transact into, you can use it as a payment method to pay for your other investments immediately. So typically, if you hold a funds, you need to sell the funds before the sales proceeds to come in, before you use the money to pay for next investment. However, AutoSweep allows you the flexibility to use it to transact immediately. Yeah. On top of that, the AutoSweep also actually allows you to use it to pay for non-SG denominated currencies. For example, you can use the AutoSweep to pay for Hong Kong dollar stocks or USD stocks. Because FSM will actually do the FX conversion on your behalf for the exact amount. So what's good about this is that you do not have any like residual non-HD currency sitting somewhere in your other accounts. So this is one good features of it. And one more thing that I really like about AutoSweep is that it has a very short withdrawal cycle. So if you're able to send your instructions before the cut-off time, you actually can have the money credited back to your FSM cash account or to your bank account as quickly as the next business day. So personally, I really like these parking facilities. So if you do not know or you are still waiting for your next investment opportunity, you can actually make use of this AutoSweep product.
Okay, so I do guess that bonds do serve as like a parking facility for something like super liquid, but also at the same time, just now Dexter mentioned that it actually acts as a portfolio stabilizer where the prices doesn't swing that much. So perhaps you can bring us back to last year in March and April where we saw an extensive decline in equity prices. So how did the bond market actually perform overall? Yeah, was it better or?
So I think initially the bond market sold off alongside equity markets. But it was something that was quite fleeting. It did not last for very long. So at some point, I think the markets realized that there are no good substitutes for bonds in terms of portfolio stabilization. So I think at the peak of the sell-off, equities fell about 30%. I think bonds, their maximum drawdown was probably about 8 to 10%. Yeah, so I think the market realized that there's no other alternative aside bonds in protecting your portfolio, and which is why I also believe that it's very important to have some form of a fixed income to stabilize the portfolio, even if you are very bullish for 2021.
Yeah, so I agree on that point. I mean, it's always good to add bonds to a portfolio. I mean, I think just to add on to your point, I think last year, if I remember correctly, I think Singapore stocks were actually underperforming SGD bonds. So SGD bonds have actually outperformed Singapore large caps for 2020. Yeah, just to add on to your point. Yeah.
Yeah, so I mean, in the very low yield environment, right, on the normal yield curve, usually the yield is a lot better because investors get compensated for longer maturity duration bonds. So, I mean, because of the low interest rates environment, is it actually wise to look in that specific segment for income?
If you ask me, I think right now, if you look at the yield curve, the longer end of the Treasury yield curve is actually sloping upwards. In fact, I think the 10-year yield has reached the point where it's exceeded the point since March or April of last year. So you can see that the longer end is actually increasing, and there is a likelihood that the long end may increase. So I think it's better to maybe consider bonds of shorter maturities and possibly in high yields, maybe Asian high yields. Yeah, so because the bonds with a longer duration, they tend to be more sensitive to interest rate movements, and as if you maybe go long at the end, the longer end of the curve, then maybe you get more. The bonds may be more sensitive to interest rates if interest rates move upwards. Yeah.
Yeah. So I think you don't necessarily have to reach out to bonds that have the longest maturities just to reach for yield. There are opportunities like I think what Dexter has mentioned in Asian high yield. The index is currently offering about 6 to 7% in terms of yield to maturity, and its duration profile is only about 3 to 4 years. So in terms of balancing the reaching for yield as well as exposure to interest rate risk, I think Asian high yield offers that really sweet spot.
I see. So I would say in a very low yield environment, bonds still does serve as an allocation to our portfolio because it provides that stability. So to actually wrap up this panel discussion, I'm just maybe just going to pick all of your brains to let me know like which segment of the fixed income sectors do you think there's like opportunities, and how investor can capture such opportunities. Is it through bond funds, unit trusts, or ETFs, etc.? So perhaps we can start with.
So yeah, so I'm into fixed income. So I think for fixed income, for certain credits, so our expectations is that for this year we expect travel-related credits to improve. So we think credits with strong balance sheets within the travel sector are attractive. So and that's because we think that the rate of vaccinations will pick up with the rate of infection. So as we know, there's global. The coronavirus cases are increasing, and that would affect the risk sentiment around travel-related names. So we think that certain credits within the hospitality and within the airlines sector are actually attractive. Yeah.
Yeah, for me, I like two segments. Firstly, Asian high yield, like I mentioned, they offer compelling yields, and at the same time, in terms of exposure to interest rate risk, they are quite limited. Perhaps another area that I like in the fixed income space is actually China bonds, right? I think China bonds, the yields have, I like them because number one, I think the currency strength is there, so that is actually like a juice for additional portfolio returns. But I think the main reason why is because I think more investors are realizing that yields across the world are so low, and I think China is the only, I would say, pretty much well-developed economy that can offer you that risk-free rate of about 3%, 2 to 3%. And that's something that is very hard to find in, for example, in the US or Europe or even Japan. Yeah.
Yep. Maybe I will share some about the retail bonds retail bonds ETF on SGX. So there are two bonds. One I would think that is quite good is the Nikko investment grade corporate bonds. So underlying there's actually all the local banks and foreign banks bonds issued. So typically it's giving around like 2%, 2.5%. And what Sean has mentioned on his interest towards the China, there's actually a newly launched ETF by the ticker code CYC. So it's actually a pure play on China government bonds. So that is giving around like 2.5 to 3%, which are quite decent in current interest rate environment. And last but not least, if you really don't know where to invest, then probably can park the money in the auto sweep so that you can actually use it for investment anytime as a payment solutions. Yeah.
Okay, thank you so much for all the speakers, your input on the exact segment or in fact the industry-specific type of bonds that we can look at as a tactical play, and how Chinese government bonds, EM and also Asian high yield do provide such yield and income for our investors here. So with that, thank you for staying all the way to the end of this panel discussion. So I'll hand over the time now back to Geraldine. Thank you.
Thank you, panelists. Since the COVID-19 outbreak, few sectors have been as unloved as financials. In light of a potential vaccine rollout, however, we believe the global financial sector could shine once again, with the very same headwinds that worked against the sector this year, setting it up for a strong rebound in 2021. Up next, we have Ferlin Tan, equity analyst, stocks and ETFs research, IFAS Singapore, to present why it's time to bank in on financials. Texture relax.
Hi everyone, welcome back to our webinar. So my name is Ferlin Tan and I'm from the Stocks and ETF research team. So today I'm here to share with you guys our 2021 global outlook on the global financials. But before I continue, I just want to say to those who have selected financials as one of the sectors that you are bullish on in 2021, I'm glad that we are on the same page. But for those who did not choose financials as the sector, I hope that I can take tonight as an opportunity to convince you otherwise. So to kickstart, I think it's safe to say that 2020 was an awful year for the financials. So financials, they play a very important role in our economy, and they are highly interconnected with everyone and everything. So naturally, when the economy suffers, the financial sector, they suffer alongside. But the good news here is that as we transit into our post-vaccine world, we believe that the long-awaited comeback of the global financial sector may finally be here. And yes, despite the run-up in over the last few months, we still think that the global financial sector is an attractive space for investors to be in today. So what exactly makes up the financial sector? So as I've mentioned earlier, the financial sector plays a very important role in our economy. And if you look around you, you'll realize that almost everyone has established at least one relationship with a financial institution. The same goes for businesses. Regardless of what industry you are in, you will need financial services at some point in time, be it for loans, for insurance, or just a simple financial transaction. And based on the JICS classification, the financial sector can be further broken down into 3 different industries. Number 1 is the banking industry, number 2 is the insurance industry, and number 3 is the diversified financials. So we are probably most familiar with the first industry, the banks. It simply refers to the financial intermediaries that connect depositors and borrowers. Next, we also have the insurance industry. So they are the ones that offer risk management products to their customers and collect premiums from them in return. So this industry can be further dissected into 2 different segments, namely the life and health insurance segment, as well as the property and casualty insurance segment, which is also usually known as the non-life insurance segment. And finally, we have the diversified financials. So financial institutions that don't belong to the banks or the insurance industry are usually lumped under the diversified financials. So there are a range of companies that offer a wide variety of financial products and services. And some notable examples in this industry would be the asset and wealth management companies, brokerages, consumer finance, and etc. And looking ahead in 2021, we see 5 key catalysts that will drive the earnings and the share prices of the global financial sector. So number 1 is the return of dividends and share buybacks across the global banks. Number 2 is the fall in loan loss provisions. And number 3 will be something on the bank's net interest margins. So the 4th point that I'll be discussing today will be the recovery in insurance premium. And finally, the last point I'll be touching will be on the growing global AUM within the wealth management space. So moving on to our first point. So what happened over the last few quarters was that due to the sudden outbreak of the coronavirus, regulators across the globe had to take several actions to ensure that the banks within their jurisdiction conserve sufficient capital to weather through this downturn. So what most of them did was that they urged their banks to halt dividend growth or to cut their dividends and to suspend any share buybacks. Whereas in some other regions like Europe and UK, the regulators took a more extreme approach where they made the banks cancel all dividends and all share buybacks till at least 2021. So unsurprisingly, the bank's share prices, they plunged when such a news came out. But the good news is, we believe the likelihood of the regulators lifting the dividend bans and share buybacks have increased substantially thanks to the successful vaccine rollout. And besides, you should also know that the banks managed to maintain very healthy capital ratios despite making hefty provisions in the first half of 2020. So these further suggest that the banks have the capacity, they have the capability to resume their dividends and their share buybacks whenever the regulators give them the green light to do so. By this point, we still want to reiterate and say that perhaps the return of the dividends and share buybacks may not happen so soon. Regulators or the banks themselves may not resume it so soon, but the thing about such capital return program is that it will eventually happen and it's just a matter of time. So it could happen as early as next month or even next week. But either way, such capital return programs have become an important factor for bank investors over the years. So naturally, we believe that the return of dividends and share buybacks will be a major share price catalyst for the global banks. And moving on, we also think that the easing loan loss provisions will be another key catalyst for the bank's earnings. So like I've mentioned earlier, in the first half, most of the banks across the world, they had to set aside huge amounts of reserves to counter the rise in bad loans that were due to the coronavirus pandemic. So unsurprisingly, loan loss provisions became the main culprit that dragged down on the bank's earnings. But the thing about loan loss provision is that they are usually more forward-looking. So we believe that 2020 would be the year where loan loss provisions peak, given how most of the bank's management have front-loaded their credit allowances in the first half of 2020. And as per guided by most of the bank's management, they are also expecting to see an easing loan loss provisions in 2021 before returning to the normal levels in 2022. So this suggests that the easing loan loss provisions will signal a turning point for the bank's earnings this year. Now moving on to our third point. Another point we believe is worth discussing will be the bank's net interest margins. So now I just want to acknowledge and say that we are expecting net interest margins to stay flat and low in the next couple of years, given how the Federal Reserve themselves, they have announced that they are likely to keep their target rate range at near zero till at least 2023, or at least until the economy shows sustained economic recovery. So using the Fed fund rates as a benchmark, we expect to see flattish net interest margins across the banks in the next couple of years. But given how the rates are already at an all-time low, we believe that any substantial compression in net interest margins is highly unlikely. And besides, during the same period, the banks, they were also flushed with liquidity where the growth in their deposits outpaced the growth in their loans. So therefore, as the global economy and the credit environment recovers from the COVID-19 shock, we believe that the banks could start redeploying this excess capital into higher yielding assets such as loans, which will provide a level of support in the bank's net interest margins, which will in turn provide a level of support for the bank's bottom line. And moving on to our fourth point, the recovery in insurance premium. So the insurance, similar to the banks, they were not spared either during the coronavirus pandemic. So insurance sales were mostly affected from, number one, the life insurance perspective. Insurance agents were unable to meet their clients due to the social distancing measures. And number two, the non-life insurance segment was also badly affected given how demand for property, demand for cars, demand for travel were all affected during the lockdown period. But as more countries start to reopen their economies, we believe that this could signal a recovery in the insurance premium. So first of all, COVID-19 has brought about a huge awareness of health insurance plans. And because of that, consumers are now more receptive towards the idea as they begin to understand and appreciate the importance and the benefits of having adequate protection. And on the other hand, from the non-life insurance perspective, we believe that the demand for travel, for car, and for property, they will rebound after the contraction in 2020. So naturally, when that happens, the demand for travel insurance, car insurance, and property insurance should pick up as well. So overall, we believe that the global insurance premiums are expected to recover in 2021 after the contraction in 2020, with China leading the rebound. And finally, on to the wealth management. So the wealth management space has always been the bright spot within the financial space, and it is expected to continue to do well in the years ahead. So global AUM in 2020 continued to register a healthy growth despite the coronavirus. So clearly, not even the COVID-19 pandemic was able to hinder such a strong growth trajectory. So the asset and wealth management industry will be driven by the increasing wealth of high net worth individuals and the mass affluent. And these wealthy individuals, these wealthy investors are constantly looking for more avenues to park and grow their assets, be it investment products such as mutual funds and ETFs, or protection-oriented products such as long-term health insurance plans. So either way, all of these will drive the growth in the global AUM, which will in turn support the earnings growth of the asset and wealth management companies. So all in all, we still see many strong tailwinds that will drive the growth of the global financials in the next 2 years. And we also see strong earnings recovery in both 2021 and 2022. Besides, investor sentiments are also expected to improve thanks to the successful vaccine rollout as well as the possible resumption in the capital distribution plans of the global financials. So our fair PB of 1.2 times translates to an upside potential of 16.2% for the global financials till 2022. And not only that, the global financial sector is also offering an average dividend yield of 3.4% in the next 2 years. So this would be perfect for those investors who are looking to receive a steady income stream while waiting for share prices to re-rate. So to take part in the growth of the global financials, our recommended product is the iShares Global Financials ETF with the ticker code IXG. So our target price for this ETF is $79 with an upside potential of 16.2%. And on the chart on the left, you can see that banks and insurance, they collectively took up almost 70% of the total net assets, which is also why during our discussion points earlier on, they are mostly on the banks and the insurance industry. And on the next slide, you can see that the top 10 holdings of the iShares Global Financials ETF. So this ETF was chosen based on our in-house ETF selection methodology, where we look at qualitative factors such as the holdings of the ETF, as well as some of the quantitative factors like the expense ratio, tracking difference, and liquidity. So this iShares Global Financials ETF has one of the best liquidity and tracking difference, and it also has a very decent expense ratio of 0.46%. So cost-sensitive investors need not worry that such costs will eat away your returns. So now let's say if you're an investor who prefers to have a country-specific exposure, another of our recommended ETF is the Invesco KBW Bank ETF with the ticker code KBWB. So this ETF tracks the performance of the banks listed in the US, and similar to the iShares Global Financials ETF. This ETF was chosen based on our in-house selection methodology, where it has one of the better expense ratio, tracking difference, and liquidity. And similarly, let's say you want to ride on the long-term trend of the China financials. Our recommended ETF for this category would be the Global X MSCI China Financials ETF with the ticker code CHIX. So this ETF tracks almost 100 companies across the entire Chinese financial sector, and it also tracks mostly the banks and the insurance. So given how China is on track to become the world's largest economy, we believe that Chinese financials will be one of the main beneficiaries. So investors who wish to take part in this growth should consider this Global X MSCI China Financials ETF. And in conclusion, here are our 3 ETF ideas for our 2021 outlook on the global financials. So let's say if you're a beginner investor or you're an investor who doesn't know when to enter the market, we recommend you to engage in our ETF RSP program, where you will deploy a fixed amount of capital into the selected ETF on a monthly basis. So just for your information, the 2 current ETFs that are available for our RSP program is the iShares Global Financials ETF and the Global X MSCI China Financials ETF. And with that, I have come to the end of my presentation today. Thank you so much for joining us. If you have any questions, do send in your question and we will try to answer them during the Q&A session later. Thank you.
Thank you, Falin. Black swan events, by definition, cannot be anticipated. Many investors were caught off guard in the early part of 2020 during the swift meltdown, with even investment-grade credits and treasury bonds selling off. The question is, are your traditional safe haven assets still safe? What are some tools, frameworks, and investment products investors may use to disaster-proof their portfolios? Up next, we have Sean Tiao, Senior Analyst, Unit Trust Research, IFAS Singapore, to share about preparing for the next Black Swan event.
Hello, everyone. My name is Sean, and I'm a senior analyst at FSM1.com's Unit Trust Research team. So today, my presentation will be talking to you about how you can actually prepare your portfolios for the next Black Swan event. So I think Black Swan events in general, like the definition of a Black Swan event is that, you cannot predict them at all, right? Because these events are very few and far in between. Like, for example, if you go to a lake, to a lake, right? It's very hard to spot a black swan in a sea of white swans, and this is the same idea. And I think when you look at black swan events, they are often the catalyst for severe losses in markets. So, for example, COVID-19 sell-off back in March 2020, we consider it as a black swan event. Markets fell about 30% over a period of about 19 trading days. So it's something that I think we haven't experienced in a very long time. So the thing about black swan events is that even the smartest person, even the best models in the world, it's not something that they can pinpoint reliably as to when it would happen. So from here until the day we retire, we are likely to go through many other black swan events throughout our lifetimes. And here's just like a list of black swan events that have happened throughout the last few decades. And of course, these events are not exhaustive, but I think it gives you a really good idea that spans across 4 decades to give you an idea of the type of events that could cause a financial event in markets. So I think back in '73, we had the Israeli-Arab War. So obviously, people were afraid as to what was happening back in the Middle East. And of course, I think back then, oil was pretty much like a commodity that no economy can live without. So that led to a pretty major sell-off, about 17%. And there are other events such as SARS, where it was something that's slightly of a lesser magnitude. I think the sell-off only was about 14% over a period of 40 days. And also we had GFC. I think that's something that we all fondly remember, or something that we have all pretty much experienced. And of course, the more recent one was COVID-19. So as you can see, they all vary in terms of magnitude, in terms of duration. So there's really no rule of thumb as to how we can think about black swan events, as to how much it will sell off or how long it will last. So the key thing about how you can prepare for your portfolio is you need certain keys or tools in your toolkit, right? So as you can see, I believe there are 4 main keys that you can look at. So number 1, diversification. You need to have different assets that are correlated differently with one another, so that in event of a market crash, not everything goes down together. And number 2, portfolio rebalancing. This is something that I think Ron has mentioned, because the idea is to recycle your winners into your losers, because markets don't go down or go up in a straight line, right? So the idea is that, for example, like your Tesla, they don't go up in a straight line, and in between they are in between, like from, let's say, in 2017 to 2020, they had massive run-up and massive drawdowns at the same time. So the idea is to take off some of the winners in your portfolio and recycle them into losers, so that you will not be subject to all these massive drawdowns, and that I think it would be a really good way to ensure that your portfolio risk is not too far from your risk appetite. Number 3, dollars cost averaging. This is something that I think Ron has also mentioned earlier, so I will not be going too deeply into points 1, 2, and 3. I'll spend more time with the 4th point, which I think will be slightly more interesting, something that probably is less unheard of, and that is volatility products. And I'm not talking about your VXY. I'm talking about volatility funds that are actually professionally managed by fund managers, and they do so for you in a very systematic way. So the first question I think I would like to address is, why prepare yourself for a black swan event, right? And I think this chart clearly shows you why. Because as an investor, the odds are stacked against you. What do I mean by that? If you look at this chart over here, the x-axis basically tells you for every loss that you make, how much returns you actually have to generate just to get back to your original investment capital. So as you can see, your portfolio has to work harder for every dollar it loses, right? If it loses 50%, your portfolio has to generate 100% just to get back to where it was before the sell-off. So the more you lose, the more it has to work harder. And I think this would be a very good reason as to why you need to think about what's ahead, how to protect yourself from any particularly large drawdown event. So number one, I'll just briefly go through 1, 2, 3. Number one, diversification. So when you look at diversification, you want to look at inter-asset allocation as well as intra-asset allocation. So inter-asset allocation, you want to be diversified across asset classes, across equity, fixed income, as well as alternative investments. Number two, for intra-asset allocation, you want to be diversified across various equity segments such as US, Asia, Europe, or you want to be diversified across, let's say, global bonds, high yield, or emerging market debt. So these are examples of how of what intra-asset allocation means. So, but I think from the perspective of myself, I do believe that in any portfolio, equities are the key source of risks. And therefore, I'll be focusing on actually trying to find ideas that can actually reduce this equity risk in your portfolios. So over here, I basically scan the universe of products that's actually available on our platform, and I try to look at it as to how these products are sensitive to global equities as well as to global bonds. So I actually highlighted the boxes in red just to give you an idea of where I'm looking at. So as you can see on the y-axis, I highlighted the box in red because I want to look for assets that are less or negatively correlated with equity markets. And as you can see, there's really not a lot of options available, right? So the key thing about diversification is to include assets that have low correlations with equities. So I'm sure this is a chart that you are familiar with that I think Ron has mentioned. So again, this goes back into the point that I'm making about correlation. Often your strikers, your midfielders, these are the ones that will score the goals for your portfolio. They're the ones that will generate the really nice returns that you're looking for. So these actually have positive or high correlation with global equities. On the other hand, your defenders, they are the ones with low or negative correlation with equity markets. So for example, you have bonds, you have maybe gold, as well as volatility strategies that I'll be sharing with you later. So key number 2, portfolio rebalancing. I will not be beating the horse as to, like the dead horse as to why you need to do that, but basically what we have seen is that it has helped to demonstrate better risk-adjusted returns for investors. So this table over here actually spans across, I would say, close to 60 years, right? So this looks at the S&P 500 index as well as the US government bond index. And as you can see, if you did not rebalance your portfolio, you would have garnered a stronger return over time, right? But at the expense of higher volatility. So from a risk return perspective, maybe you're not better off, right? You're only better off in total return terms. But can you actually imagine living through the entire 60 years and weathering drawdowns to drawdowns, and some of which are pretty large? I think with bonds, you will definitely have like a easier time with it because your overall portfolio volatility will be much lower. So dollar cost averaging. I think to me this is quite important because it really manages your investor psychology, right? It reduces the impact of volatility by spreading out your investments over time. So you're not too worried about thinking about whether you're invested at the wrong time. Is this the market top? Because by spreading out your investments across a long period of time, you basically take emotions out of the market. You take, there's no element of market timing. and you're actually forced to think long-term. And I think dollar cost averaging is actually best suited for investors or who don't have the capacity to monitor their investments, or they simply don't have the view or knowledge as to how they should construct their portfolio, or like where they should invest in at any given point in time. So this is the evidence of why dollar cost averaging works, right? So this is probably one of the worst case scenarios ever, the Great Depression. And as you can see, the chart, just follow me as I go along as you look at the chart. If you look at the blue area chart over there, it basically tells you what the amount of money you have invested should you have conducted an RSP during the Great Depression. And the red area chart basically shows you what the value of your investments would have been during this period, right? And as you can see, it did not really take long for you to actually recoup your losses, right? You know, I think some financial media has actually mentioned that it has taken about, I'm not sure, about 20 or 30 years just for the Dow Jones Index to get back to where it was in price terms. But in terms of your portfolio value, it will only probably take you about 2 years. So this is one of the worst case financial event that we have ever mentioned, that the world has ever experienced. And it only took you 2 years to actually break even. So it's not too bad. Another major event I would say perhaps is the World War II event, right? Similarly, we have seen a pretty significant drawdown, about 60% in equity markets, in US equity markets, right? And again, the results are quite similar. Within, I would say, less than 2 years, you would have break even, right? So the thing is, you have to focus on the long game, on a long term. You cannot living from day to day. Otherwise, you will not be able to sleep very well. Because the point about investing is not to give you, more white hair, but really so that you can actually have a really comfortable nest egg to retire from in the future. So I think this will be the key part of my presentation. So I'll be talking to you about one volatility product which I believe can actually help to diversify your portfolio even better. And I will just briefly run you through about what volatility products are. So when you invest in a volatility fund, right, it's what they do is basically to buy derivatives, whether futures or options on indices, right? So it's akin to, I would say, paying insurance on equity risk, right? So the idea is that with all these derivative exposure, if equity markets fall, you get something out of it, right? So in good times, when equity markets are on the rise, you will not see anything, but in bad times, you will have a pretty high probability of actually providing an asymmetric payoff for your entire portfolio. And this can actually serve as a very attractive portfolio hedge versus just investing in bonds, for example. So why am I saying this now? Because I believe there is an increasing need for alternative portfolio diversifiers after seeing what the bond markets have undergone earlier in March 2020. Because even the best bonds would sell off when people are rushing for exits, when people are rushing for liquidity, right? And as you can see from this chart over here, I think it says very clearly, even the safest fixed income segment, which are the US government bonds, they are not immune to sell-offs. So why is that so, right? Because I think over the last 4 decades, it's been a very sobering reality for bond investors, right? We have been in a bull market for bonds over the last 40 years. And over these 40 years, the yields have been basically on a downtrend. So there is an erosion of yield cushion that I think bonds usually provided in the past, right? But the thing is, there is little to no substitution for high quality fixed income, right? There is nothing like, for example, your US Treasury bonds that can basically give you a risk-free return, right? But I think having seen what happened back in March, I personally believe that there is an increasing need for alternative portfolio cushions, which I think a volatility strategy can provide you. So the thing about volatility is that it has a very nice affinity with drawdowns, with market drawdowns. Why? I mean, the simple reason I could come up with is because investors don't rush to buy, but they would rush for the exits, right? So when they do that, that contributes to market volatility. And as you can see, this is the 130-day rolling drawdown, and the black line is the 130-day rolling annualized volatility of the MSCI AC World Index. And as you can see, as the volatility rises, we tend to see market drawdowns. Yeah, and I think adding a product that actually benefits from a rise in volatility from market drawdowns can actually help to add to your portfolio diversification. So this is just a very simple illustration of how it works, right? Again, this is just a very simple illustration because professionally managed volatility strategy funds, they do have more complex strategies as to when they would gain exposure to volatility. But again, this is just to highlight as to how it works. So when the VIX index is often the benchmark for what people think volatility is, right? So when the VIX index goes up, generally speaking, it means the insurance premium to buying put options rises. So in a way, people would perceive it as fear rising. And often, this would coincide with market drawdowns, as you can see from the chart over here. When fear rises, we see drawdowns, and when fear dissipates, we see markets going up. So let's just try to think about how we can actually add a volatility strategy to our portfolio mix, right? So first, we have to create a very simple bond portfolio. So let's just say that we include these three funds into our fixed income exposure, right? So these three funds are actually our recommended fund for the various segments. BlackRock Fixed Income Global Opportunities is the recommended fund for global funds, for our global bond funds. Fullerton Asia Bonds are our recommended exposure for Asian bonds, as well, and Fidelity Global Bond is also our recommended fund for global bonds. So we have two recommended funds for global bonds, just so that there's no confusion here. And let's just try to add a fourth fund into the mix, which is the Nexus Swan Volatility Strategy. So this is the volatility product that I've been talking about, and let's just call this the Black Swan portfolio. So let's appraise its performance over the last 1 year, right, in 2020. So of course, I think for every investor, there is a different bond equity mix. So so I have three over here in the table: the conservative investor, the balanced investor, as well as the aggressive investor. So this, of course, of varying risk profile, they have varying equity exposure and fixed income exposure. So let's just say that we have an equal weighting to all the bond to all the products within the Black Swan portfolio. So 25% in your volatility strategy and 75% in your other three funds. So effectively, when you have this kind of exposure, your conservative investor would have a 15% exposure to the volatility fund, effective exposure. Your balanced investor would have about 10%, and your aggressive investor would have about 5% effective exposure. So these are the results that we have seen if you include volatility into your portfolio. Your portfolio drawdown as a whole would be much lesser than what you would have actually experienced without adding volatility strategy into your fixed income exposure, right? So in terms of outperformance, in terms of drawdown, right, like your drawdowns would have been 6.7% less for your conservative investor, balanced investor about 5%, and your aggressive investor would about 2%, right? So of course, at the end of the day, it boils down to how much you're allocating your portfolio to portfolio diversifiers like strategies like this. So all in all, I think the key point to take away from this chart, this table is basically volatility strategy can contribute to lower downside risk and drawdowns, and that is because of the fund's asymmetric return profile. So if you look over here, it basically shows you how the black swan portfolio would have fared against the average global bond fund. Right? So at its peak, it would have a 12.5% return difference versus your average bond fund. And this is at a point where bond funds are selling off, right? So imagine the black swan portfolio, 3 bond funds are actually losing money, but you have this volatility strategy that actually is able to not just make up for their losses, but also to provide that 12.5% return difference. And this is on a 2-year period, right? So I think the key thing that I also want to mention is that volatility strategies are negative carry assets, right? So why do I say that? Is because, like I mentioned earlier, you are actually paying, in a way, insurance on any market drawdown event, right? So if markets fall, you actually get compensated because of exposure to volatility. But even so, I think the portfolio drag that volatility strategy actually contribute to your portfolio is not that much, right? So if you consider, like if you're a balanced portfolio investor, right? If you have about 10% exposure to your volatility strategy, if 10% effective exposure, your effective portfolio drag will be anywhere from 0.25% or 0.5%, and that is a small price to pay to actually protect yourself from any black swan events. And I think this is like on a 3-year basis is also the same thing. Now, I think you will probably be like thinking about what is the long-term performance of the fund, and the reason why I only show you 3 years is because this fund had a change of strategy in 2017. So I think it would not be fair to actually look at its performance prior to that, and which is why I'm only showing you up to 3 years. So all in all, I would like to conclude that adding volatility as a strategy can be to your portfolio. It is a defensive asset. They can provide you this asymmetric return profile, and that like automatically, because of its nature of its investment mandate, it will have strong negative correlation with equities, right? And that all when combined together will contribute to lower downside risk for your portfolio and drawdowns. And at the end of the day, you can sleep better and you can be a happier investor. So in conclusion, I think I would like to reinforce the main points that we have been talking about, which is diversification, portfolio rebalancing, regular contributions, and the new one that I hope perhaps some of you would go home and think about is volatility funds, right? And the thing about markets is that it's an infinite game, it's an infinite lifespan. After we are long gone, they will still be here, right? So there will always be opportunities in the market. Our aim as investors is to win, but we don't have to win inconsiderably, right? Because our second objective is to survive for as long as possible. And just remember the first chart that I showed you, the odds are always stacked against you for every loss you make, right? So remember to survive. Thank you for listening to my presentation, and I hope you gain something out of it.
Thank you, Sean. We'll now take a short break as we head over to our speakers at the Q&A panel. If you haven't already done so, you can leave your questions regarding the presentations for today in the Q&A function. We'll see you shortly. Welcome back, everyone. Joining us here on the panel to take your questions will be Ron Ng, Investment Advisor, FSM1.com, Singapore. Ferlin Tan, Equity Analyst, Stocks and ETFs Research, IFAS Singapore. Sean Tiao, Senior Analyst, Unit Trust Research, IFAS Singapore. And moderating this session will once again be Catherine Chua, Assistant Manager, Investment Advisory, FSM1.com.
Thank you, Geraldine, for the introduction. So thank you for staying until now to view our Q&A. So across the past 2 hours, we have received numerous questions, about concerns investor, like what to invest, like which ETF to look at, and some general questions about investing. So perhaps to kickstart this Q&A, I will just start off with one of the highest voted questions that's on the list, which is, what is the long-term view on Singapore banks given the upcoming entries of digital banks that could actually dilute banks' market share? So perhaps, Ferlin, would you like to take this question?
Yeah, okay. So first of all, the entrance of the digital banks is definitely going to bring some healthy competition for the traditional banking space. So when it comes to this topic on digital banks, I usually, there's two schools of thoughts for me personally. So first of all would be the digital capabilities of the traditional banks, and number two would be the competition in the loan space. So first of all, I think it's great that the digital banks in Singapore, they will be regulated on an equal footing as the traditional banks, which means that MAS will not be more lenient towards these digital banks, which is definitely a plus point for the traditional banks. So when it comes to the digital capabilities, I think it's also great to say that our three local banks, DBS, UOB, and OCBC, they have been investing and innovating, putting in a lot of money when it comes to these digital capabilities. So naturally, our banks, they have the digital capabilities. We believe that they have the digital capabilities to retain their users while fighting against these digital banks. So that's why my first school of thought. So secondly would be the competition for loans, right? So I know a lot of investors are always asking, will the traditional banks be replaced by the digital banks? So first of all, when it comes to that, I think the investors, they usually tend to overlook one very important aspect when it comes to loans, which are the corporate loans. So digital banks, they are not here to replace the traditional banks. So they are here, their objective is to serve the underserved segment, which is the SMEs, right? So naturally, we think that the corporate loans for the traditional banks are safe, which is also the main bread and butter for the traditional banks. So from that point of view, I think investors need not worry about how digital banks will replace these our traditional banks. Yeah, so this is my thought. Oh, another thing is usually digital banks, when they apply for the banking license, they usually have an objective in mind, and it's usually to enhance their ecosystem. It's not to take in loans just for the sake of taking away the market share of the traditional banks. So from that point of view, I think investors should not have to worry so much of the competition from the digital banks.
Okay, I see. So, I mean, just a follow-up question. I don't think it's on this quick Q&A, but personally, I'm just keen, like, what's your view of the Singapore banks? Like, is there any preference between any of these three banks?
Okay, so for the Singapore banking space, we are positive on this space. We have actually shared our view on the Singapore banks just a few weeks ago. And to answer your question on which bank do I prefer, personally, from the business point of view, I like DBS the most, given how it's the largest bank in Singapore. And I think it is also one, compared to the two other banks, it is the one that started investing in technology the earliest. So naturally, it has a competitive edge over like UOB and OCBC. So another thing I like about DBS is that, so from their deposits point of view, they have one of the highest percentage when it comes of CASA, which is current account and savings accounts. I remember last time I checked it was about 50 to 60%, whereas for UOB and OCBC it is hovering around 40 to 50%. So the higher this CASA ratio, the cheaper the deposits. So which is already like a plus point for DBS. So personally, from that point of view, I like DBS the most.
Okay, thank you so much for your insight. So, I mean, moving on, there's also a couple of questions that's asking about, like, ETF that's within this financials banking space, and also if there is any unit trust available on this platform that we can actually get exposure to right on this banking sector.
Yeah, maybe I'll go. So for bonds, yes, we do have UTs that give you exposure to the global financial sector. So our recommended fund is the Fidelity Global Financial Services Fund. So this is a fund that invests only in traditional banks. But if you're someone who wants the exposure to fintech, we also have another option. And that's the BlackRock Fintech Fund, right? So the difference between these two funds, I mean, aside from the name, is that the BlackRock fund invests about 50% of the portfolio to actually companies that they believe have that fintech exposure, and while the other 50 is in traditional banks or like payments, payment providers, right? So if you look at the performance difference between these two unit trusts, right, you'll find that the fintech fund has actually done really well compared to your traditional banks. And I think one reason why is because I think COVID or not, disruption in banking sector is here to stay, and that there are going to be beneficiaries during this disruptive period. And I think for certain there will be fintech companies that will come out on top. They will take some market share away, and I think if you're someone who wants that secular growth as well as that value exposure, then perhaps the fintech fund is good for you. But if you're someone who just wants to take advantage of like a cyclical recovery that's happening out there, and that you think value or cyclical stocks will outperform, then you might want to go for Fidelity Global Financial Services. Yeah.
Okay, thank you.
Okay, so to repeat again, for the ETF, currently our like the main ETF we think investors should be looking at is the iShares Global Financials ETF, which looks at all of the banks, insurance, diversified financials across all industries. So no preference for any country or something. So because we believe that the tailwinds that I've mentioned earlier during my presentation, they will help to drive the growth of all financial institution, regardless of industry and regardless of country. So if you ask me like which ETF I prefer, it will be this iShares Global Financials ETF.
Okay, thank you for your insight. So there's also another one of the highly voted question was about the interest rates. We all know that it's so low now, lower and longer. So there's a question like, why do we still need to hold bonds in our portfolio? It doesn't make sense, right? So, and the second part of the question is about when interest rates goes up, bond prices do come down, so returns will be affected. So maybe Ron, you can help us with the first question, like how. Yeah.
Okay, so basically, low interest rates. There are a lot of investors who feel that since it's already at zero interest rate, the only way is to go up. But I think my panelists would not disagree that negative interest rate is not uncommon. So I think the key question here is if you're of the view that we're already at the bottom, it can only go up. The question would be when would it go up? So back to our what FSM1 advocates, which is not to time the market, whereas to invest in a diversified portfolio over the long term. So essentially, what we would recommend is to have diversified in terms of having equity and both equity and bonds inside your portfolio over the long term, and not to just solely monitor interest rates and try to time the market, because chances are we might get badly burned.
Yeah. Okay. How about Sean for the second part of the question about the interest rates rising, and then how would it affect the bonds prices?
Yes. Yeah. So I think if you believe that interest rates are rising, the long end of the treasury yields are rising, then of course you do want to have less exposure to bonds. I mean that's a natural reaction that I think investors would think of, or like a solution they would think of when they believe rates are expected to go up. But the key question is, how certain are you it will happen, right? Because I do believe that humans are poor predictors of where markets will go, right? If you just think about what your thoughts were back in 2020, right? For example, were you bullish? Were you actually bullish back in March, April, May, June? Were you actually expecting a sell-off in 2020 after what has happened in March? So if you have, just think about how many times you actually thought of it. So just try to, as I try to link it back to this, is that we cannot know, it's very hard to predict what will happen, even or when interest rate will rise. So I think from that perspective, I think bonds are still important, because even if you believe markets will go up, they don't go up in a straight line. And if they do go up in a straight line, you should be worried, right? So I think bonds still have a place in a portfolio. So even if you do not like bonds, maybe you can have less of it. But I think at the bare minimum, you should still have some of it, just to ensure that, in worst case event where another black swan happens, right, you are well protected. Yeah.
I see. Okay, so taking it further, there was another question that was asking about, besides bonds allocation in the portfolio, does it make sense to also invest in gold as an asset class to hedge against uncertainty and all?
Yeah, I think gold, in terms of from a diversification point of view, it can be a good addition to your portfolio. So if you look at the long-term correlation with that the gold has with equities, with global equities, you'll find that it's almost close to zero. So what this means is that there is no clear relationship between gold and equity markets. So from that perspective, it's a good diversifier, and I would actually think of, personally, I have a small exposure to gold in my portfolio, and I do it not because I'm speculating on gold prices, but solely because of the portfolio diversification aspect. And the reason why I actually don't really have that large allocation is because gold prices can be quite wild. I think what happened in last year, I think it has risen all the way to $2,000, and along the way it has experienced a pretty massive drawdown of about 50% or so. So I think from that perspective, I don't see it as a speculative asset, but I rather see it as a portfolio diversification tool.
Okay, Ken, thank you. So, coming to that, something like a portfolio stabilizer, a bond fund, right? If let's say investors really do anticipate that Fed hike would start rising its interest rates again, is there a bond fund that we can actually consider, like a specific segment of bonds that we can get ourselves exposed to anticipation of such interest rates changes?
I think without a doubt, if rates were to rise, if that will come to fruition, all fixed income assets would be hit. So the question is, which will be hit less? So I think from that perspective, I'll be looking at shorter duration bonds. So duration, for those who are not aware of this term, basically informs the investor of how much the bond fund will actually decline in value for every percentage increase in interest rates. Right. So I would favor those with very short duration profiles. And the really safe ones that I can think of right now are basically your short duration bond funds like Nikko AM, short duration bond fund, or Lion Global Enhanced Liquidity bond fund. So these, I think these two bond funds have duration profile of about 1 year or less. So it is very attractive if you are someone who just wants to have diversification, and yet you don't want that massive duration exposure. So another idea, I guess, like I mentioned in my panel discussion earlier, would be exposure to Asian high yield. So Asian high yield gives you about 7% in terms of yield, and its duration profile is about 4 years. So let's just say the Fed actually hikes rate because of really good economic data, inflation data coming out. They hike rate by 1%. So we estimate that that the bond fund will take a hit. The average Asian high yield bond fund will take a 4% decline in value. But because it's actually giving you 7% in terms of yield, you are more than compensated for this potential rise in interest rates. I guess it only becomes unattractive if you truly believe that interest rates will be hiked by 2%, 3%, which I think it's really, really unlikely.
That's too aggressive already.
Yeah.
Perhaps I can add on. So let's say if you expect interest rates to rise, you should really consider investing in the financials, right? Since how the financials, the equity side is very reliant on the interest rates, because interest rate is basically an indicator of the bank's profitability moving forward. So if you are of the view that interest rates are going to rise, I think you should really consider staying invested in the global financials.
I see. So apart from actually looking at like bond segment, we can actually look into the equity segment specifically for all these financials, right? So there was also another question that's asking about like a safe ETF that investor can choose to RSP regular savings, start a regular savings plan with. So perhaps Ron, do you have any comments on like any suggestions?
Yeah, actually we get that a lot from the investment advisory team because investors are always looking for safe assets to maybe park their funds or just wait for a good time to invest. So leaving your money in the bank account is not one of these solutions. So usually for ETFs, we would recommend in this ETFs that tracks bond indices. But if you're looking at an even safer instrument, then perhaps you can consider money market funds on our FSM1 platform. So it's very easy. You just go on to fsm1.com, go to fund selector and select asset class money market. The whole list will be churned out in less than 1 second. So if you are really risk averse, money market funds. If you want to take on a little bit more risk, then like what Sean mentioned, short duration bond funds.
Okay, Ken, thank you so much for all your replies. So maybe due to time constraint, maybe I'll just take one last question from the Q&A pool. I think one of them is very interesting. They asked about will there be a market correction soon? So just wanted to hear some of your ideas, where do you think this correction may come from, or what do you think of such speculative comment? Because we really do hear that a lot coming from clients that tell us that markets can fall in a couple of months and they are just sitting on the fence, not waiting to invest. So is there any takeaways for them? Yeah.
I think for sure there'll be another major drawdowns in equity markets, right? And the question is when. So I don't claim to know when it will happen, but I think we can think about what are the conditions that would lead to market drawdowns, right? And I think one thing that I'm always looking at is how, I think one of the Q&A concern was yields could be rising. And that is a key concern for me, because if yields were to keep rising, at some point, I think it would also suggest that inflation is back again. And when it comes back, I think at some point, the Fed will have to come in and perhaps tighten. So that to me is something that I'm always looking out for. The condition will lead to a policy response from central banks that will lead to monetary tightening. But I cannot say when. So, it could come 1 year from now, it could come 2 years from now, even 3 years from now. So that's why I'm always, even for my portfolio, I'm always diversified, right? Because I don't want to play this game of making predictions, because more likely than not, I would be wrong 90% of the time.
Yeah. Personally, I think nobody knows whether the market is going to crash anytime soon. So usually when I do my own investments, I will do my own due diligence. I think one of the more important things is the valuation of the stock that you are looking at if you are worried of a market crash. So sometimes when you look at the valuation of a stock, I will realize that the upside risk is actually higher than the downside risk, which is if there's a potential market crash. So I think that's one important aspect to look at. If it's like overvalued, then obviously when something bad happens, the story of the stocks changes, right? Then it will crash even harder than those other stocks with better valuations. So instead of trying to keep figuring out when the market is going to crash, why not take the time, study a company better to see where it stands in the market, so that to see if it can withstand another black swan event, for example, see that if it can survive. And for example, if you look at the S&P, I think that we can see that after the 2008, it has never returned back to that level. So if you are someone who keeps worrying about this kind of thing happen, then I would say that there's a high chance that you always miss this kind of 10 baggers opportunities in the market. Yeah, so this is my personal view.
Yes, and lastly, Ron.
I think to add on to what both my panelists have already shared, I think if you look at the news every day, there's always something to worry about. So basically, I mean, now there's the pandemic, COVID-19. After COVID-19, there's a trade war. So after trade war, there might be even something else. So I think the key thing is not to filter out market noise and to just really stay invested, be it in instruments that you are comfortable with, and I think you should be good to survive another pandemic.
Yeah, okay, thank you so much all our speakers for participating in this Q&A. So we have come to the end of the presentation and I hope that you guys find very useful insights not only into ETF, unit trust investments, as well as individual stocks and sector to actually concentrate in for your investment portfolio. So right now, I'll just hand over the time back to Geraldine again.
Thank you, ladies and gentlemen, for that insightful discussion, and to our audience for your questions. We'll now proceed to the daily quiz, where 3 winners with the most accurate and fastest answers will walk away with $100 worth of FSM1 multi-currency cash account credits. To access the quiz, you'll need to be on Event Live and click on Event Activities on the black menu below the video window. Under the agenda, look for the quiz schedule. Click on Join Quiz, and the activity window will be displayed on your right. Once the quiz ends, a leaderboard will be displayed, and you may check if you're one of our winners. If at the end of the quiz, the results screen show rank 1, 2, or 3, congratulations, you are a winner. So to claim your prize, take a screenshot showing the whole activity window and ensure that your rank, score, and nickname are captured clearly. Are you ready? Let's start the quiz. Let's start with a warm-up question. What is a survival kit? Is it a kit with basic mandatory supplies that aids in one's survival? A garment for one's survival? Or a kitten that survives? This question is meant for you to warm up your fingers so you can be one of our fastest and most accurate. And the answer is a kit with basic mandatory supplies that aids in one's survival. Great job! Now for the first question. What analogy does FSM1.com use when constructing a portfolio? Is it a pie, a jungle, a soccer team, or a basket of eggs? Fastest fingers first. Pick the answer you think is the most correct, and you may stand a chance to win $100 worth of FSM1 multi-currency cash account credits. And the answer is a soccer team. 70% of us got it right. If you didn't get it right, it's okay. We have 4 more questions. You can check your ranking. Are you in our top 3? If you are, keep it up. If not, it's okay. You have 4 more questions to catch up. And get ready for question number 2. Which of the following refers to the interest paid out by a bond until the maturity date? Yield, returns, coupons, or dividends? I'm going to go with dividends, but then again, I might be wrong. So pick the answer you think is the most correct. And pick it fast. Oh no, I got it wrong. The correct answer is coupons. If you got it right, congratulations. 64% of us got it right. Good job. We have 3 more questions to go. I can see some of us have caught up. The first 3 rankings have changed. If by the end of this you are our top 3, you may stand a chance to win. Question number 3. Which of the following is not a reason why FSM1.com views China banks as attractive investments? Option 1, share buybacks. Option 2, strong loan growth. Option 3, healthy capital positions. Or option 4, easing loan loss provisions. Remember, we are asking for a non-reason. And the answer is share buybacks. 40% of us got it right, followed by 31% choosing easing loan loss provision. If you got this wrong, it's okay. We have 2 more questions to go. Don't give up. You got this. As you can see, the top 3 keeps changing every round. So if you're not in the top 3 this round, it's okay. You have a chance to climb up the ranks with our next question. Question number 4. What does not describe black swan events? Option 1, a catalyst for severe losses in the market. Option 2, unplanned, unexpected events in the markets. Option 3, few and far in between, like spotting a black swan. Or option 4, when a seemingly good investment turns out to be a bad one. And the answer is option 4, when a seemingly good investment turns out to be a bad one. Remember, if you are in our top 3, you are our lucky winners. Now on to our final question. Which of the following statement is false? Option 1, high returns equals taking on higher risks. Option 2, conservative investors should be overweight equities. Option 3, emerging market equities are riskier than money market funds. Or option 4, unit trusts allow investors to tap on the fund manager's expertise. Pick wisely is our final question. And the answer is option 2. Conservative investors should be overweight equities. If you are in our top 3, congratulations. You have won $100 worth of FSM1 multi-currency cash account credits. If your results screen shows rank 1, 2, or 3, remember you must take a screenshot showing the whole activity window and ensure that your rank, score, and nickname are captured clearly. Then email the screenshot and also include your name, FSM account number, and the daily quiz date to events@fundssupermart.com by 31st of January to claim your prize. That is all we have for today, but what and where to invest is not over. In just 2 days, on the 14th of January, this Thursday, we'll discuss more investing strategies you can employ. Some highlights you can look forward to are Rasmin Ang from The Fifth Person, who discusses whether to go for growth or dive in on dividends in 2021. Lim Yu In, the fund manager of the Disruptive Innovation Fund at Lion Global Investors, will share with us more opportunities within disruptive innovation. And Yo Wei Ren will also be back with a presentation of his own entitled Investing in the Future of Technology. Here are 3 ETFs you should know about. In addition to that, we'll have more exciting days of insightful presentations coming up on the 19th and the 21st, and a special Chinese-only presentation on the 26th of January from 7 p.m. to 9 p.m. in the evenings. We'll also have with us Timothy Ho from Dollars and Cents, plus Dawn, the Budget Babe, and Kenneth Lowe from Sidley, who will be sharing on the 21st of January in a session dedicated to helping those who are new to investing get up to speed. Don't forget to tune in, as each day we'll be giving away $100 worth of FSM1 multi-currency cash account credits to 3 lucky winners in the daily quiz. Each day is also a new opportunity for you to accumulate chances for the lucky draw that's happening on the 21st of January, where the lucky winner may stand a chance to win up to $1,000 worth of FSM1 auto sweep account credits. It's goodbye for now, and don't forget to check out the rest of the promotions FSM1.com has launched in this period. We hope to see you on the 14th of January at 7 p.m. Thank you and goodbye.